Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss tariff and inflation uncertainty put the Fed on pause, government debt sustainability and crowdfunding, health savings account limits increase in 2025, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, our pick for the Super Bowl was successful, not what we expected. So other than that surprise, how's things going for you?
Yeah, I would have thought it would have been a much closer game. But, it actually worked out. I ended up working part of the first half of the Super Bowl, so it wasn't pulling my attention away from getting some things done. But, yeah, otherwise, things are going well. We're here at the beginning of tax season, still waiting for some forms to be released. So, the real push will come in a week or two probably. But so far, we're maintaining a pretty good pace.
Yes, sir. Absolutely. All right. Well, let's jump into tariff and inflation uncertainty put the Fed on pause. There's lots in the news right now. Of course, Donald Trump was vocal about it, that tariffs were going to be something that he was really going to look at. But we're given the real picture here. So what is going on with the Federal Reserve, the Open Market Committee, interest rates? Where are we at this point?
Yeah, we've talked some about the tariffs and the potential impact in the past, and in essence, the conclusion that we follow is tariffs are likely to be somewhat inflationary. They are likely to put some upward pressure on inflation, but at the same time, if you kind of work through the math, it's probably not going to be as bad as at least what I'm reading predicted in a lot of the media. So not great in terms of bringing inflation down, but also not the disaster blooming that I think some are predicting. But that creates a bigger challenge for the Federal Reserve Open Market Committee, right? As they said, interest rates. Last year they started normalizing rates, right? They started with a 0.5% cut in their target short-term rate, followed by 2 additional quarter-point cuts for a total of 1% for the year. And they appeared poised to continue to lower their interest rate target in 2025. But, we've seen headline inflation kind of stubbornly kind of vary between 2.5% and 3%, which is still a bit above the Fed's long-term 2% target. So in their most recent meeting, they chose to pause, and kind of signaled that maybe, the likely path for future interest rates is still downward, but it may be much slower than what people were previously expecting.
What are some of the main concerns that the Feds have right now with the uncertainty on the impact of tariffs?
Yeah, I think part of it is the tariffs and the effect that could have, and maybe thinking better to take a wait and see approach. I think we have seen goods prices, especially food, increase a bit, right? Everybody talking about the price of eggs, but really food across the board has moved up. While the services sector, which had been the really kind of stubborn part, has continued to come down, but very slowly. So I think the bigger long-term trend is still in favor. But I think one of the big things to pay attention to that the Fed didn't necessarily talk about, but I just know from past experience and working through how the Fed thinks that I'm sure it's something that they're looking at is the change that we've seen in consumer inflation expectations.
Mm.
And we've talked about this in the past when inflation was high and kind of looking at what the likely path was. And one of the interesting things about inflation is the biggest determinant of future inflation is consumers' current inflation expectations. So in many ways, inflation is almost a self-fulfilling prophecy. If people believe inflation will be high, they will, behave in a way that will cause it to be higher.
Sure.
If they believe that inflation will be low, they'll behave in a way that will likely cause it to trend downward. And what we've seen recently, if we look at the University of Michigan Consumer Sentiment Survey, we saw a pretty quick, sharp increase from inflation expectations over the next year jumped from less than 3% to a little over 4%. So, as we said, the headline number currently is about 3%. So, in essence, consumer inflation expectations are showing, they expect that rate to continue to rise. And I think that's probably something that has the Fed pretty nervous just because of that historical correlation between inflation expectations and the reality.
What usually occurs with consumers when the inflation expectation is high? Is it that just yeah, there's not too much of an adjustment on spending for goods and services, or it's really factored in and they start cutting in those areas pretty rapidly?
Well, what tends to happen is if you think future prices are going to be higher than today's prices, you're more likely to buy things now,
Mm,
right? Rather than pay more in the future, stock up in essence, if you will, right? Thinking that that's a good investment because of the savings. And so in doing so, you create more demand now, but right now there's a limited supply of goods and services, right? You're pulling that demand forward. Whereas if you expect the inflation rate to be low, you may hold on to your money, leave it in the bank and earn some interest or invest it and buy the things as you need, right? So
mhm.
there's no added demand that comes in that would then cause prices to increase because if there's higher demand and the same amount of supply, that's going to push prices upward. We often see similar things with hoarding, like we saw during the pandemic, right? Or even you could argue right now egg prices, as has been talked about. You see those pictures where Costco gets a delivery and people swarm it and they buy all the eggs, right? And they're buying you hear people talk about, well, I was going to get one carton of eggs, but with prices and, potential scarcity, I decided to get two. Well, if suddenly everyone's buying double what they normally would, supply chains can't adapt to that quickly.
Right.
So, you have one of two things that you can do. You either have to limit, right? So you have to say one per customer, which then is a problem if somebody normally buys two or three or five because they own a bakery or who knows, right? So that's not necessarily efficient. Or you let the market adjust and you let prices go up. And
Right.
if the price is high enough, then people might say, do I really want to, pay that much? Or can I afford to pay that much to load up on a bunch of eggs? Or, do I want to take the risk that if I buy too many and I don't use them, these expensive eggs will go bad, right? And it'll change that behavior. So you see those types of changes in consumer behavior based on expectations for shortages or rising prices, and in a way, it often becomes a self-fulfilling prophecy.
Yeah, I know that's interesting. Bring it up. Recently, we purchased a new dishwasher around here. It was kind of a situation. Yeah, and do we look into getting it repaired? And it just made sense at the right price. Plus, that was something that we talked about. Well, the prices could go up here soon enough, so now just seemed like a right time to do so. But we didn't think of it in these terms, but it makes sense.
Yeah, yeah. I mean, for the most part, these are rational decisions where you end up having market failures is when the market's not allowed to adjust, right? So a great example was during the pandemic when they were talking about price gouging and not letting, stores raise the prices. Well, the problem is if they can't raise the prices, then there's no downside to people buying all the toilet paper.
Right.
But then when I go in there, I want to be able to buy some toilet paper if I need it. And if need be, I'd probably be willing to pay a higher price than to just not even have it available at any price because they sold it all out very cheap. So the free market is pretty good at adjusting. Granted, we don't always like it when we're paying a high price for toilet paper or a high price for eggs. But it will, make that adjustment. Um, and then there, of course, there's the real question of okay, with what's being priced in terms of the potential inflation effect with tariffs or inflation expectations. You have to look at it and say, okay, is the market over or under pricing that potential, right? So just because there's a kind of a prediction of what we're going to see doesn't mean that it will happen. What will that impact be, especially on interest rates going forward?
Yeah. Well, what about as far as long-term inflation expectations?
Yeah, long-term inflation expectations have remained fairly subdued. If you look at the 5 year, it's around 3%. It was around 3%, ticked up to like 3.25%. So what it appears is that consumers expect short-term inflation, and then it will moderate, back more towards that 3% expectation.
Well, let's talk the bottom line here when it comes to tariffs. I mean, there's no way that it doesn't have an impact. I think that's just something that has to be made clear. Am I correct in that thinking?
Yeah, anytime you disrupt supply chains or change rules, I mean, there's going to be adjustments, there's going to be some impact. Now, I think, what is sometimes lost on the conversation and remains to be seen, and it's really, I think, would be very difficult to predict, is those impacts can be positive or negative.
Mm.
Trade is not a zero-sum game, and good trade deals do lead to win-win scenarios. So, tariffs as a tool to maybe renegotiate, potentially could create some positives. We'll have to wait and see. I think going back and looking at the USMCA, the U.S. Mexico Canada trade deal that was done in Trump's first term, if you read a lot of the reports that different think tanks put out, it actually appears that it was a win-win across the board. It better streamlined a lot of trade. It created a lot of private investment flowing into Mexico and shifted, more and more production from China into places like Mexico. So, that was a win among the different participants, which is a possibility if if better trade policies are negotiated out of this, which I think is partly kind of what we're seeing is maybe different views in terms of the dichotomy between how the bond market is responding and how the stock market is responding, right? We've seen the 10-year government bond rate shift up and bonds sell off as a part of this trade risk. But here we're sitting with the stock market near an all-time high. So
Mm.
clearly it's potentially focused more on the optimistic view as opposed to the pessimistic view of what tariffs and the potential risk of a trade war could bring.
Yeah, much like many of the things that you and the team address here in the personal financial review, this is just sounds like another situation in which you know made the headlines overly sensationalizing, and we've got to give it time to see how this plays out. That it's not going to be a rapid impact one way or the other.
Yeah, I think that's the key. We saw that a few weeks ago where there was the tariff announcement or the tariff threat on Canada and Mexico. The stock market opened that Monday down 2%. They decided to postpone them. By the end of the second day, it had recovered, right? Obviously anyone who, would have panicked on that short-term news and reacted too quickly, would have missed out on the recovery as well as the gains that have come since. Yeah, I do think it's very important to be patient, gather the real information to be able to figure out what's really going on here, as opposed to just reacting to the headlines.
Yeah. All right, let's jump into government debt, sustainability, and crowding out. The state of U.S. government finances has, of course, been in the news, and we do touch on it. And, the Department of Government Efficiency, DOGE, and others, there's a lot of criticism around this method that is going on, but it is shedding some light on how our government has been spending tax dollars.
Yeah, that's often the challenge with a lot of these things, right? It's I think people can rightly criticize that the Department of Government Efficiency, some of their methods and going in and being very heavy-handed and at least seeking to cut out big portions of government spending is probably not the measured, more thought out methods that most would like to see. But on the other hand, just the fact that people are now focusing on, the fiscal situation of the U.S. government and as you said, shedding a spotlight on it, so that people understand where we are, I think is really important. And I think it is maybe an opportunity, maybe a similar to what we had with the Clinton administration in the 90s to really look at government spending, which of course eventually led to the U.S. actually running a surplus, right, after running big deficits. And arguably, the U.S. federal budget deficit and the national debt is one of the biggest long-term risks facing the U.S. economy and as an extension, the financial markets. Currently, the U.S. government is running a $2 trillion deficit. So it's basically spending $2 trillion more than it brings in tax and other revenue. And this is, in essence, double the estimated sustainable amount. Ray Dalio, the famous hedge fund manager, is now retired. Has recently put out a book. He's put out a number of books, and he's a very long-term thinker of markets, and that was a big part of his success throughout his career. He makes a very compelling argument that governments that run deficits at the level that we are for too long, in essence, leads to debt crises and eventually those governments or those countries failing. So, we do need to bring down that deficit. If we could cut $1 trillion of spending out of the U.S. government budget, that would put us on a more sustainable path where even though we'd have $1 trillion deficit, we can at least keep up with that in terms of economic growth. And it would remove, that pending risk that's out there, out there down the road. We don't know how far because you never know how far on these things, where you could all of a sudden find yourself in a really difficult situation where you're in a debt crisis, so your interest rates are rising. You then need to, implement austerity, so you need to cut spending in order to, reduce the deficit. But then because your interest costs are going up, you need to cut even more than you otherwise would have to. But then because those cuts are so large, you're actually reducing the pace of economic growth, which results in lower tax revenue. So now you're in a position where you have to cut even more, thus, the death spiral, right? You have to cut to get ahead on top of your debt. But those extreme cuts cause the government or the economy to slow, so it reduces your revenue. So you have to cut more, which causes more slow down in economic growth, and you end up in this debt spiral, which is really the worst case scenario. And again, we have no idea how far out that may be if we were to continue on this path, but it seems at least if we could take some steps, even some baby steps in the right direction, and try to do that consistently to reduce that potential risk.
Yeah. What are some areas that are maybe getting less attention as far as the impact of U.S. government borrowing that maybe folks are not there's just simply not enough attention to get educated on it?
Yeah, so I just made the risk case, right? That if we
Yeah.
can bring the deficit more in line, that would reduce the potential risk. But there's also the opportunity case that I think is not getting enough attention,
Mm.
and why this could really be a good thing. Because one of the things we need to take into account is when the U.S. government's running a big deficit, they're borrowing large amounts of money, and you end up with what's called crowding out. The government is going to get funded first at whatever the interest rate may be. And so when the government has very high demand for money, and let's say the supply is the same, there's only so much money out there to be lent, it will push up the borrowing cost, not just for the government, but for every other type of debt. So if the US government's, borrowing $2 trillion more than let's say it otherwise would be, it's going to, soak up that money. And then let's say the next thing that would be funded is government-backed mortgage bonds.
Mm.
Well, those are likely going to have to pay that much higher of an interest rate in order to attract the money that they need, right? And thus it circles into the real economy where, people complain about how high interest rates are and how it makes houses unaffordable. Well, high amounts of government borrowing and that crowding out can contribute to that. And that can flow through, a whole number of financial products of all types of borrowing. And then you eventually get down the list and there's certain borrowing that just won't get funded.
Right.
right? Because the money was going to the U.S. government instead of to a maybe private borrower, and maybe that borrowing that doesn't get funded is the riskier high interest rate borrowing, but to the extent that some of those investments may have paid off, they would have led to a higher rate of economic growth. Whereas if they're not funded, obviously they won't even have that opportunity.
Yeah, so it's definitely, as you mentioned, that spiral, another huge factor of that we don't just look at the government situation, but that for individuals that are trying to prosper and families.
Yeah, and that's a way, that we can bring down interest rates, bring down inflation. That doesn't necessarily lead to slower economic growth. The
Right.
Fed has to weigh the balance of, raising or lowering interest rates. If they raise interest rates, it brings down inflation, but it also slows economic growth. If they lower interest rates, it sparks economic growth, but also creates some inflationary pressures. Reducing the government deficit, because it is really pulling money out of the economy, but at the same time is allowing interest rates to potentially come down because of less government crowding out. It's a more balanced way to reduce inflationary pressures and potentially get a little bit higher rate of growth based on more attractive borrowing rates.
Yeah, well, and that makes sense to me. Tell me if my thinking's wrong. That starts to happen. More lending for businesses. That's tax revenue potentially coming in, more homeowners, et cetera, et cetera. So it's really kind of counterproductive to continue on the path that we're on here.
Yep, that's the flip side, right? We talked about the debt spiral. That's the virtuous cycle, right? That everything's growing and moving in a positive direction and reinforcing each other so that yeah, it makes it easier to dig ourselves out of this hole once we get things more into equilibrium.
All right. Well, let's jump over to health savings account limits increase in 2025. We touch on this every year to give a review. So, what are we looking at for 2025 as far as health savings accounts?
Yeah, so health savings accounts, these are tax benefited savings, usually only on the federal level. A lot of states don't conform, but some do. It's for people that have high deductible health insurance plans, right? So they have these lower cost health insurance plans where, they're on the hook for that high deductible, whatever it may be, the first, five, six, seven, $8,000 out of pocket. So they're taking on that risk, and then they are able to contribute to a health savings account, which they can use to pay those copays or other health related expenses. So for those that have a high deductible insurance plan, they may already have an HSA set up, or they may want to set one up, but the limits have increased for a single self only plan. It went from $4,150 to $4,300. And for a family plan, it went from $8,300 to $8,550. So, beginning of the year, a lot of times people make deposits directly from their paychecks, so they may want to bump that up to make sure they're on pace to max it out if that's their target.
You mentioned the tax benefits as well. How does it really create a tax benefit for an individual or that of a family?
Yeah, people often talk about the triple tax benefit that a health savings account can have, or sometimes they're called medical IRAs for that reason. But the benefit is when you put the money in, you get an immediate federal tax deduction, right? So you're not paying taxes on that. Then while it's in the plan, if you're not using it, you get tax deferred growth. That can either be earning interest, or some plans will allow you to invest a portion of the money. And then if the distributions are used for qualified medical expenses, those distributions are tax free. So you never end up paying taxes on the money. Now, in some cases, there may be some other options for flexibility as well. So if someone's age 65, the idea when they're 65, they're now on Medicare, so they're no longer on a high deductible plan. They could basically take money out without any penalty,
Hmm.
or could even convert the amount in a health savings account into a retirement account like an IRA.
Okay. What about as far as when it comes to determining eligibility? Are these usually health savings accounts something that if you have a job so your employer, it's something you set up through, or even if you're an independent contractor, are there options, or does it depend upon if you have HMO, PPO plans? What are some of those factors that people want to keep in mind?
Yeah, generally, as people look at their insurance options, they'll find that there will be an option that will say HSA eligible, right? And that will be that high deductible plan. And of course, you want to read through that plan and understand what you're going to be on the hook for, because there are potential higher out of cost or out of pocket costs if you need care. And people probably want to then weigh their situation, right? Their current age, their frequency of doctor visits, what medications they're paying for, what all their out of pocket expenses are to say, okay, does this make sense? Is it worth taking on some of this risk? That I'll be able to put money into a health savings account and not necessarily spend it all each year, but be able to carry it forward for future needs. So if someone's a low, usage of the medical system, it probably makes a lot of sense. If they're a higher usage, then it may not make sense for them.
Right, absolutely. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. We got one item pinned up there. What do we got, Mr. Armour?
Yeah, we've had a number of people asking about when the Schwab 1099s for non-retirement accounts will be available. And I've been, waking up every morning and checking, is today the day when the bulk of them are going to be posted? Schwab announced that the first batch, which was the more basic reporting, was issued on January 31st. So we have seen, quite a few issued. They had originally said that the second batch would be posted online on February 14th, but that did not happen. So, here you and I are recording on the 20th, and they are not yet available. But they had also stated that, they expect them all to be, mailed and posted by February 28th. So we're kind of in this in between phase where, probably sometime between now and the end of the month. But we don't have any further guidance.
Yeah. What about far as small accounts? What's concerning that?
Yeah, so we have had some clients ask about, oh, I haven't seen my 1099, is it coming yet? And in some cases, if it's a small account or if it's an account where maybe you own some stocks that they don't pay any dividends, and
Mhm.
if the dividends or interest is less than $10, then Schwab is not required to issue a 1099. So, if you don't have a 1099 posted and you're wondering why, it can make sense to look at the transactions and say, okay, how much interest or dividends were actually paid during this year? If it's less than $10, there's not going to be a 1099 issued. You just, go through the transactions, count up the amount, and go ahead and report it, even though it's less than $10. But you don't need to delay your tax filing, waiting for that to happen. For others, some people I know have been holding off on sending in their tax data, waiting for those 1099s. What I would recommend, whether we prepare their taxes or they have others, go ahead and if you have everything else, send it in. And, we can go through and get everything done. And then we're just waiting on those one forms to be able to wrap everything up rather than delaying everything until the forms are, come out, which then can cause a real bottleneck in the amount of workflow.
Mr. Armour, anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
No, I'm just excited that it looks like the rain's gone for a little while and it's supposed to hit 70 degrees. So if I can just get through tax season, I might have an opportunity to, get out on the golf course, and it's encouraging that the weather's starting to look better.
Yes, sir. I was outside for work yesterday, and I went, boy, I can actually take my sweatshirt off. So hopefully we're heading that direction. Of course, we thank you all for listening or watching the Plan Solutions podcast. That's right. We're available on YouTube. You can go to youtube.com/@plansolutions and follow along there to the personal financial review, the written content that we discuss here. And if you're not yet subscribed to that, Make sure to send Katie an email and get subscribed to the Personal Financial Review. It's KATIE at plansolutions.com, and you can click her email address in the podcast description.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.